The housing market isn't waiting on rate cuts anymore. Two things just changed, quietly, and neither one is getting real attention in the headlines. One is happening deep inside the financial system. The other is happening right on the ground in neighborhoods across the country. Individually, each one matters, but together, they change the trajectory of the housing market. And by the end of this video, you'll understand why lower interest rates may not save housing this time. Right now, everyone thinks they know what comes next. Buyers are waiting for rate cuts. Sellers are hoping inventory tightens again. Investors believe housing will just muddle through like it always does. But all three groups are missing the same thing. Because housing doesn't break when demand disappears. It breaks when support quietly vanishes. And that's exactly what's happening now. Without a press conference, without a headline, and without most people realizing it. Force number one, the quiet exit from mortgage support. Let's start with the part most people misunderstand. When people talk about the Fed and housing, they focus on one thing, interest rates. If rates go down, housing should recover. If rates stay high, housing struggles. That logic used to work, but today it's incomplete. Because the most important support for housing over the last decade wasn't just low rates, it was who was buying mortgages. For more than 10 years, the biggest buyer of mortgage-backed securities wasn't a pension fund, or a bank, or a foreign investor. It was the Federal Reserve. Let's slow this down and explain it simply. A mortgage-backed security, or MBS, is just a bundle of home loans packaged together and sold as a bond. Your mortgage, your neighbor's mortgage, thousands of others. When investors buy those bonds, it provides funding for new mortgages. Now imagine this. Imagine an auction where one buyer shows up with an unlimited wallet. They don't care about price. They don't care about yield. They just keep buying. What happens? Prices go up. Yields go down. Everyone else feels safe buying too. That's what the Fed did. Through quantitative easing, the Fed became the buyer of last resort for the mortgage market. At its peak, the Fed held over $2.7 trillion in mortgage-backed securities. That artificially pushed mortgage rates lower than they ever would have been in a free market. And over time, the housing market began to assume that support was permanent. But here's the part that matters now. The Fed does not want to own mortgages. They've said this repeatedly, in speeches, in meeting minutes, in long-term planning documents. Their goal is a balance sheet made up mostly, or entirely, of US Treasuries. Why? Because owning MBS means they're no longer neutral. They're subsidizing housing. And politically, economically, and structurally, they want out. So how do they exit without crashing the market? They don't sell. They let the mortgages run off. As homeowners refinance, sell, or pay down loans, those bonds mature. And instead of reinvesting that money back into new mortgages, the Fed lets that demand disappear. This is quantitative tightening, QT. Quiet, relentless, and structural. This is not a pause. This is not temporary. This is a permanent retreat from being the backbone of the mortgage market. And on its own, that already matters. But paired with what's happening next, it becomes dangerous. For 2 years, the story was simple. There's no inventory. Sellers are locked into low rates. Housing can't fall if no one sells. That story is changing. Active listings are rising year over year. Days on market are increasing. Homes are sitting longer. And here's the key detail most people miss. Inventory isn't rising because demand is booming. It's rising into weak affordability. That's the difference. Buyers today aren't credit constrained like in 2008. They're payment constrained. They can qualify, but they can't afford the monthly payment. Even when rates dip, the payment often doesn't fall enough to matter. Why? Because the mortgage rate isn't just tied to treasuries anymore. It's tied to risk premiums. Premiums that used to be suppressed by Fed buying. With the Fed stepping back, private buyers demand more yield. That widens the spread. So even if the 10-year treasury falls, mortgage rates stay stubbornly high. Now combine that with rising inventory. Homes take longer to sell. Price cuts increase. Sellers lose confidence. And suddenly, psychology starts to shift. This isn't a demand collapse, it's an affordability ceiling, and markets break at the margin. This is where most housing analysis fails. People analyze rates, or inventory, or demographics. Very few connect Fed balance sheet mechanics with market psychology. Here's the loop. The Fed steps away from MBS. Mortgage spreads widen. Monthly payments stay high. Buyers hesitate. At the same time, inventory rises. Homes sit longer. Sellers cut prices. Those price cuts don't create urgency. They create hesitation. Buyers think, if prices are falling, why rush? That slows transactions further. Housing is priced at the margin, and the margin just weakened on both sides. Let's make this real. If you're a buyer, lower rates may come, but payments may not fall enough to change affordability. You'll have more choice, less competition, and more negotiating power if you're patient. If you're a seller, 2021 comps are gone. Liquidity matters more than valuation. Pricing realism isn't optional anymore. It's survival. If you're an investor, cash flow beats appreciation. Leverage matters again, and the Fed is no longer your silent partner. Housing will still exist, but it won't be protected the way it was. Let's talk outcomes without hype. Scenario 1, the grind, base case. Prices move sideways to slightly down. Transactions stay low. Inflation does the work of real price declines. Scenario 2, regional breaks. Overbuilt, investor-heavy markets correct 10 to 20%. More constrained regions hold up better. Scenario 3, psychology flip, risk case. Buyers step back together, sellers rush listings, and with no Fed backstop, the market searches for a real clearing price. This isn't 2008, but it is a balance sheet correction, and those don't need panic to be painful. Let's bring this together. For more than a decade, the Federal Reserve quietly supported the housing market by buying mortgages. That era is ending. At the same time, inventory is rising into the worst affordability environment in modern history. Individually, each force slows housing. Together, they change its structure. This isn't about predicting a crash. It's about recognizing a regime shift. And that shift will create both risk and opportunity depending on where you live. In the next video, I'll break this down by region and zip code, showing where this collision shows up first and which areas may actually benefit. I'll see you there.